Hello.
Hi.
Welcome, everybody. Thank you so much for joining us for the first track session on the fundamentals of Excel and financial modeling. I'm delighted to introduce Alastair Matchett, the founder and MD of Financial Edge Trading. Welcome, Alastair. Thank you so much for giving up your time to come and speak to us.
Thanks, Charles.
Alastair is the founder of Financial Edge Trading. He has over 23 years experience teaching on Wall Street. He set up Financial Edge Trading in 2016, and it's now the firm chosen by the top 4 investment banks to deliver incoming new hire programs. So before instructing, he worked in private equity, and before that, he was in mergers and acquisitions at J.P. Morgan. So I will hand over to you at this point, Alastair. You've got a very controversial topic title, which I'm really looking forward to. And I'll jump back in at the end with Q&A if you need any support.
Brilliant. Thank you, Giles. Thank you, Giles, and welcome. So we have got a kind of short session to cover, and we're going to try and do around about half an hour, a little bit longer than half an hour. And I want to talk about an issue that has come up in the last couple of years. And this is very focused on the investment banking community. Okay, so rather than necessarily project finance, but this is kind of investment banking that we're really talking about. Because the standard 3-statement model that people know and love and tons of people learn and train on, actually, when you get into an investment bank and you're working in an industry team, they are hardly ever used. Perhaps they'll be used in credit or in leveraged finance, but generally speaking, actually doing a 3-step model is very unusual to do if you get into an industry team. We teach most of the top leading investment banks entry training programs, people like Goldman Sachs, J.P. Morgan, Morgan Stanley, and we teach their new hires going into investment banking. We also have online programs which you can do as well. Now, the thing I want to go through really quickly is just touch on what 3-step modeling is if people don't know. And then I'm going to give you a little bit of a story about how this really came up, about the fact that 3-step modeling is dead. And then what I'm going to do is give you an example of the kind of models that investment bankers will be building rather than 3-statement models. So if you think about a standard 3-step model, you have the 3 financial statements, an income statement, balance sheet, and a cash flow statement. And they can either be on a single tab. And if you put them on a single tab, that's usually because you're then going to add additional models to the workbook: a discounted cash flow valuation, trading comps valuation, deal comps, etc. And having it on one tab makes it kind of neat because it's just in one place. Larger models, leveraged finance models, project finance models, you probably want to spread over multiple tabs. So that's the kind of standard 3-statement model structure. And it integrates from the cash flow statement flowing into cash and the income statement flowing into retained earnings. And sometimes it's known as integrated modeling or integrated 3-statement model. But why is this dead? Well, let's tell you first about how we actually came up with the fact that this is dead. And it comes as a result of the lease accounting changes. Now, for those of you who are not accountants, I know you may just kind of give me a 1,000-mile stare right now, but there's been a major shift in the accounting for operating leases. And under IFRS accounting, which is the accounting used by most of the world, the accountants have decided to make a standard approach to accounting for leases, which is known as capitalized leases or finance leases. And that means the asset you're leasing goes on the balance sheet as an asset, and the liability goes on the balance sheet as a financial liability, and you charge interest on the liability, which runs through the income statement, and depreciation on the asset, which runs through the income statement. But of course, in US GAAP, they wanted to be different. So in the United States, their accounting system, which is not the international standard, they use US GAAP. And they did a fudge, which is like a halfway house. And frankly, this is just a disaster. So what they do is they still put a lease liability on the balance sheet. They put a lease asset on the balance sheet, all fine. But instead of charging interest and depreciation through the income statement, they just charge a rent expense, and that gets put into the operational costs. So whereas most of the world is actually treating these new leases as debt equivalents on the liability and making sure that they're not included, the cost of them are not included in EBITDA. So hence interest and depreciation is not in EBITDA. In the US, you've got a problem because although on the balance sheet, the leases are separated out, on the income statement, the costs of leases are embedded in your operational costs. So we actually polled a number of banks, including the major banks, people like Morgan Stanley, Goldman, J.P. Morgan, and said, look, we've got this real issue. We've got to teach our incoming class of analysts. And what are we going to do about this fact that US GAAP is different, the accounting for leases is different from IFRS, because our case study, we use a global case study, and we use some European and Asian companies and some US companies. And they said to us, well, we kind of ignore leases. And I was thinking, what? How so? And they said, if leasing is not that important in the industry, we kind of ignore it because we don't really do three-step modeling. And I was kind of thinking, oh my gosh, really? This is what we're teaching on your analyst program and you don't do three-step modeling? They said, yeah, because there's no point. Actually, what is most important in the model is building out the cash flows, understanding the cash generative ability of the firm, and then also modeling the debt sheet. There's no point in doing a full balance sheet and a full cash flow statement. So in effect, what we now have when we're looking at models in most investment banking industry teams is we will have an income statement and maybe some calculations. Then we'll have a cash flow statement or kind of levered free cash flow, and then we'll have a debt sheet and no balance sheet. Now, why would they do this? The first critical issue is that this makes the model about half the size of a three-statement model. And it allows you to push out pretty much all the outputs that you need without building an income statement, balance sheet, and cash flow statement. So essentially, it saves time and gives you the same answer. So what we're going to show you, I'm going to show you now, is we're going to build a little income statement, levered free cash flows, and a debt schedule. So levered free cash flows are kind of similar to free cash flows, except they will include the interest expense that's running through the income statement. And this means, and I'll show you the difference between the three-step model and this more simple, literally income statement, levered free cash flow, and debt schedule. And that's pretty much, if you go into investment banking, that is actually what most people are doing rather than building three-step models. So this idea that everybody should train on three-step models, really, actually, it's not that important, certainly in investment banking. So I was kind of shocked at this. And then I said to them, well, should we take the three-step modeling out of the training program? And they said, no. Actually, it's kind of useful for people to understand three-step modeling because it reinforces the accounting and you can kind of see how things fit together within the accounts and how things affect the balance sheet and the cash flow statement. So they still want us to teach that, but actually what they're doing in the model is something much simpler and much more summarized. Okay, so that's really just the introduction. And now what I'm going to do is I'm just going to show you in Excel exactly what this looks like. And I'm going to start by just giving you an example of a full three-step model. So what we've got here is just an example. This is actually a real company, but I've just redacted it for the purposes of this session. We've got a set of assumptions at the top here. Then we've got a set of calculations, kind of base calculations. And then we've got an income statement, a balance sheet, a cash flow statement, and a debt schedule. And then what I've also done at the bottom is a levered free cash flow. And I'll explain why once I've done the other model. The levered free cash flow is there because one of the key things that bankers now like to look at is and check is that the levered free cash flow should equal the change in net debt. Now, I'm going to do that in the next model. So this is the standard three-statement, old-fashioned way of modeling that actually most people on Wall Street don't do anymore in most industry teams. But we're now going to go into the levered free cash flow version. And if you just look at these two models, this model that I've built here, if I just exclude the levered free cash flow analysis at the end, this is about 180 lines long. The levered free cash flow version, if I just go down to the end, let me just use my keyboard, there we go, is about 109 rows long. So it's not quite half, but it's almost half. So we still have all the standard assumptions here. They're still there. We've still got some calculations. And just to save a little bit of time, I put the calculations in. So we've got some operating working capital calculations, and we've got an income statement. And just a standard income statement, we've got everything down to EBIT. I've left out interest because I haven't done the debt schedule. And then I've calculated recurring net income and the diluted EPS. So I'm just going to copy across the income. Well, actually, I'll leave one column. I don't need to copy it across. So I've done the income statement there. Pretty standard. Nothing different from what you would do in a three-step model. And I've also done some calculations here. And for the most part, there's nothing different that you would do in a three-step model because I've got the operating working capital here. But I've also had to add all the other line items that the cash flow statement will need. So rather than do those kind of base calculations that you saw in the other model, I've just left 3 lines: the change in or the other long-term assets, the other long-term liabilities, and capital expenditure. And the reason we need that in is that we need that for the levered free cash flow. So we've got our calculations, we have got our income statement, and now we've got our levered free cash flows. So what the levered free cash flow is essentially everything that is on the cash flow statement except the repayment of debt, both short-term and long-term debt. I've started at net income, so that means it includes interest income and expense, and then we add back the depreciation and amortization, take the change in all the balance sheet items. Although we don't have a balance sheet, we've still got them in the calculations, and we're also picking up dividends. Now, I'm doing this very much from an investment banking point of view, so I know there'll be some people in the room who are from a project finance background, and they will be literally having to lie down in a darkened room by some of the summarized features that investment bankers do, because investment bankers are working at a really tight time scale, and they often will summarize some of the analysis that they will do. So what I'm going to do here is I'm just going to pull in my net income from the income statement. So let me go up and pull in net income. So that's the top of the levered free cash flow. Let me just pull that down too. And then I'm going to add back the depreciation and amortization. Just change the sign, and I'm going to pull that up from above. And then the change in the other long-term assets. Now, normally in a three-step model, we take the change from the balance sheet item, but in this case, we're just going to go to the calculations. You have to make sure that you have all the items available for that. So I'm going to come to the other long-term assets, and I'll just take the prior year because it's an asset minus the current year. And then we've got the change in other long-term liabilities, and I'll take the current year because it's a liability, and it's a direct relationship of cash flow minus the prior year. And then we've got the change in operating working capital. Now, some people like to put long-term assets and liabilities in operating working capital. I don't do from a credit perspective, because the operating working capital should just equal the cash cycle changes. And often the long-term assets and long-term liabilities are much longer dated items, since they're almost like non-cash adjustments. So for the increase, decrease in operating working capital, I'm going to go to the operating working capital in the prior year, and subtract the balance of operating working capital in the current year. There we go. And I've got that down there. And then I'm going to pull in capital expenditure. And I've got that in the assumptions here. I'm just going to flip the sign, so to multiply by -1. And I get 137.4. Now, this is probably a little bit small for you to see. Let me just zoom in a bit. There we go. So I've got that. Now, the dividends. Now, I know if you're from a leveraged finance background or you're from a project finance background, you'll say, well, hold on, you can't pay dividends before you service the debt. But in a general corporate model, you would actually take out dividends. So, for example, when BP had that disaster in the Gulf, the Deepwater Horizon, they still paid their dividend, even though they had a massive lawsuit of about $40 billion, because all their shareholders were saying, look, we're equity income funds, you can't just cut the dividend. So in a standard corporate model, actually, you would normally forecast dividends as an extraction before you service debt, not in a highly leveraged model. And for the dividends, I'm going to, again, this is going to make some of you have to lie down, but mostly what we'll do is we'll just take the dividends per share number, which is 0, and we'll multiply that by the basic weighted average shares as a proxy, because you don't pay dividends on a option. So I should multiply that by -1 because it is a negative item there. So I've got that, and then I'm going to sum that up to get my levered free cash flow. So the levered free cash flow is essentially everything that you would see on a standard cash flow statement, except the repayment of short-term and long-term debt. So we've got 2 things so far, well, 3 things really. We've got our calculations at the top, then we have the income statement, and then we've got the levered free cash flows. And then what we're going to do is we're going to do a little debt schedule. And I'm going to do this kind of quickly. So we'll do the beginning balance of the short-term debt is equal to the ending balance. And notice I'm assuming there's no existing short-term debt. And then for the issuance repayment, this is a standard kind of cash sweep mechanism. So what we're going to do here is we're going to do the minimum of the beginning balance or the levered free cash flow times -1. Now, the min functions, I just love them. I mean, they are literally about the best thing that Excel has or Microsoft has ever created. It's literally, it's the kind of heroin for leveraged finance bankers, because they can do kind of cash sweeps using the min functions. And it's just beautiful because it will deal with situations where you run out of cash, where you've got enough cash to clear the short-term debt and enough cash to pay some of the short-term debt. And then I'll sum that together, and then we've got a little interest rate for the short-term debt, which I'll go and pick up from the assumptions. Here we go, which is 0.5%. And I should just quickly make that a percent. I like to use styles as formatting. I know a lot of people have add-ins for those, but actually a lot of the investment banks don't allow you to use the add-ins. They have kind of their own corporate add-ins, and the popular ones are actually things like FactSet. FactSet is a very, very good add-in to Excel that does all the formatting automatically. So, and then I'm going to do the average of the balance of the debt multiplied by the interest rate times -1, just to make it negative. There we go. And then I'm going to go down to senior debt. Now, I've made this model a little simpler because I'm just going to do a kind of cash sweep cascade through here. And I've done that just because we don't have masses of time and I've got to squeeze this in. So I'm going to make it a little bit kind of leverage financy just for the purposes of getting this done. So our senior debt is the first dibs after the short-term debt. And then I'm going to do another min function, my favorite function in Excel, the min function. So we're going to do another min of the beginning balance. But in this case, what we're going to do is we're going to take the levered free cash flow plus what we've used to repay the short-term debt, okay? And then times -1. You could have had a little subtotal there, but in this simple model, you really don't need to do that. And then the interest rate, because this is actually, this originally was a fixed interest rate, I'm just going to reference the prior cell, and then I'll take the average. Here we go. and I multiply it by the interest times -1, and I get 5.9 there. And then I'm going to do the next cascade, which is the sub-debt, subordinated debt. Again, I've just simplified this for the purposes of this session. And then another min function quickly. So I'll do equals min. And again, this is just if you have used the cash of the short-term debt first as a priority, then the senior debt, then the sub-debt gets last dibs on the cash flow. So I'm going to do the min of the beginning balance and then the levered free cash flow plus what we've used in the short-term debt plus what we've used in the senior debt. Those brackets times -1. Just check that's right. Yeah. And then I'm just going to sum that up and we'll do interest. And again, I'm just making that interest rate reference the prior year because actually this was, I've changed the, these actually were bonds, but I made it kind of senior debt, subordinated debt, just the purposes of this session to get everything done in the time. Interest expense, I'm going to do the average of last year and this year, multiplied by the interest rate times -1, and I get 19.2. So I've done pretty much all the model. Now, what I've also got here is I've got the net debt or cash. So what I've got here, this is the balance of the debt schedule, okay? And what I can do here is come down and just take the, if I just copy this right, you can see here, that is the new debt balance, okay? So that's the new debt balance. But I can also calculate the net debt by just taking the levered free cash flow. If I go and get the levered free cash flow, 35.4, I could also calculate the net debt, if I just show you here, by taking last year minus the cash flow. In other words, we repaid the cash flow and we get the same number. So a lot of bankers in our programs are saying, look, we really want people to understand that your levered free cash flow should equal the change in net debt, okay? So even if they do a 3-step model, that is why in the prior model down here, I put a little calculation of levered free cash flow. And then I just also put in the net debt, and you should be able to check that if the change in the net debt equals the levered free cash flow, the model works. So a lot of bankers have been saying to us, look, we really want people to understand this, is that when you're modeling, you should be able to calculate levered free cash flow, and that should equal the change in net debt. And that's a really good check for the model. So it's almost like having a 3-statement model and checking that the balance sheet balances. It's the same kind of concept. You're checking that the levered free cash flow equals the change in net debt. Now, if I come to the, I copy this right all the way through the model, you will see that this, there we go, just copy that right, and there we go. So we have our debt, a little model here, and we've got the, either we can calculate the net debt by summing up the debt items, or we can calculate it by the net debt minus the levered free cash flow. So what we've got here is a model that actually does everything that a banker would need, but much more simply. You've got the income statement, which is the kind of key driver of value of the business. You've got the levered free cash flows, which is servicing the financing. And then you've got the debt schedule. You really, from a banking perspective, you don't really need much because the levered free cash flows, the income statement can be used for your kind of performance and valuation, okay, because you've got earnings there. Your levered free cash flows are used for debt service and also DCF valuation. You don't need to build out a 3-step model to do DCF valuation. And then you've got your debt schedule, which is your kind of your financing section of the model. So in investment banking, that's all you need. You do not need 3 statements. And what you have here is you have a situation where you've got a model that's 109 rows long versus a model with a 3-statement situation, which is 176 rows long. And that's actually that's what the bank has said to us. They said to us, look, we just don't model 3-step modeling. It's just not worth it. It's too much effort. There's too much in Excel. All we'll do is just a levered free cash flow model, and it's about half the size and does pretty much all the analysis. So that's really what I wanted to show you today, because that is the modern way of doing investment banking, is using levered free cash flows rather than 3-statement models. Now, we do have a little bit of extra time, and I'm just thinking what we could do. Maybe what I'll do is just squeeze in some, I could do a multiple variable data table, but I haven't prepped that, which I really ought to. Let me also just give you, Q&A, we're given 5 minutes. Okay, so great. Let me just squeeze something in really quickly. Another approach to investment banking is if you want to do scenarios. So let me assume if I just put in the sales growth here, as actually I'll leave that there. I'll just copy it though. And let's say we have just a couple of assumptions for sales growth. We've got, let's say, the upside, and then sales growth, the downside. Yeah. Just, there we go. Let me just delete that. And what I'm going to do is I'm just going to make this, I'm going to just change this to 2%, right? Just to make things easy. Now, let me explain to you, there's a couple of ways in which you can do scenarios. You can use a ton of different functions. You can use the choose function, you can use the index function, you can use the offset function. In a situation where you have a single assumption, the best thing to use is the offset function. And let me explain why. So what I'm going to do here is I'm just going to reformat this. Oh, I need to be really super careful because I will add in an Excel that really messes up. So I'm just going to do this. I'm going to use my old shortcut because Excel hates it. There we go. So I'm going to do a little offset function. Let me just zoom in a bit so you can see what I'm doing. So equals offset. And what the offset function does, you want to go to the very top of the assumption block. That's your starting point. And the best way of explaining the offset function is it's rather like, you know, those treasure maps when you're little, and it says go to the spot marked X, and then do 3 paces right or 3 paces west and 3 paces south. That's essentially what's happening here. So that's our starting point. Then it's asking us how many paces right and how many paces left we're going to do. And the first one is rows. So what I'm going to do is I'm just going to reference the blank cell here and absolute reference, and we don't want to go any columns right. So it's just going to give me 0 initially. But if I come here and I put in, so this is C3. So my assumption is in C3. So scenario, I do C3, I put number 1, it will pick the first choice. If I pick number 2, it will pick the second choice. And you're probably thinking, well, why is he doing this? This is kind of, you know, I know how to do offset functions, but let me explain why this is super useful. Also, what I would normally do here is I'll do another offset here, which is to this cell here, comma, the number of rows offset here, comma, 0, because that will just tell me which scenario is being used. And if I just copy this right, I've got a scenario in this model, and I've got a little switch here, and I can choose number 1 or number 2. Great. Why is this so good? It's so good because your managing director comes to you and says, Alastair, we want another scenario. If you'd used a choose function or an index function, that means you have to start remodeling the sales growth line. So with an offset function, there's some beauty to this. So if I now put sales growth and I put MD's, managing director's assumption here, and I change this, and let's say they're kind of going to be middle of the pack at, let's say, 3%. I don't need to do anything else. All I've done is added one line, because now my offset function will still work with number 3 because it just counts down a further line. So if you want a beautifully simple way of doing scenarios where you can literally interleaf additional scenarios, the offset function is for you, because it means you don't need to then fiddle about changing this formula here or anything else that is being used by that switch. It just means you can add another assumption. So for single cell assumption or single line assumptions, the offset function is just a really beautiful function to use. Oops. No, formula text. Let me just show you the formula just in case you didn't get that. Okay, so that's the offset function I'm using there. Really beautiful. Okay, that's pretty much me done. And I've got my 5 minutes up.
Thank you.
Hi, Giles.
Hello. So you've had a couple of questions, and I've got a really provocative question myself that I'm going to throw at you in a minute. The first one is just, are you able to share the file that you were presenting?
Oh, sure. Yeah, absolutely. I can do that. That's no problem. Yeah,
Great
I will
stuff.
do that.
Okay. There was a question a little bit earlier about, let me have a look. So Elton said, what about the interest of previous short-term debt? I don't know if you've still got the context of what he was referring to. Going through the modeling. The
interest on previous short-term debt, if you have an existing balance of short-term debt, I mean, you would, so because you've got a forecast, so that you wouldn't have any interest of previous short-term debt, you would just have interest. If you had a balance of short-term debt, then that interest will just flow through the model, and the min function would allow you to repay that short-term debt if you've got cash, or if you run out of cash, issue the short-term debt. So I think I'm not sure quite what's meant by the interest issue for history, because if it's interest, old interest, that would just be old interest. But if you have an existing short-term debt, an existing balance of short-term debt, yeah, you'd have interest on that, and that would flow through the model into the income statement. Oh, one thing I didn't do, gosh, I didn't put the interest in the income statement to iterate the model, because I just didn't do that. But that's, I guess, that's what they probably meant. I left interest on the income statement blank, so I didn't create a circularity. I will add that into the file when I okay, so when you're modeling, so I think this is kind of, when you're modeling the long-term debt repayment, I thought you need to deduct interest payment of the same period. Yes, you would do, Elton, but the interest in the model, I don't know if I can share my screen again, Giles, can you?
Yeah, you can.
Yeah, so effectively what happens is, and that's something it's a bit naughty not doing this, but what I would do here is normally do an if statement that says, a little circ switch here. If the circ is equal to 1, then pull in the interest expense, which in this case would be that plus that subdebt, or 0. So this is just making sure the switch is set to 0 now. I'm going to turn the switch on. So what happens here, I think the question is, are you missing out interest? And yeah, I am at the moment because I didn't put that formula in. But if I quickly go to number 1 here, and that turns the iterations on, and you can see interest is running through here, which affects net income. And then that flows through into net income at the top of the levered free cash flow. So that changes the levered free cash flow, and that will change the debt repayment. So levered free cash flow incorporates interest expense. So I think that's probably the question.
Yeah, I think Elton's come back and said, yeah, that's it. So thank you for that. That's great.
Yeah, so apologies for not doing that.
Good spot. You've had a couple of other questions. So Callum, under the new approach shown, are there any limitations to the balance sheet ratios or mixed statement ratios produced?
Yeah, that's a really good question. So the most important leverage functions that the investment bankers will use will typically be debt to LTM EBITDA as a leverage ratio, rather than the capitalization ratio of, let's say, total debt to shareholders' equity. It's just a more relevant, and also sometimes free cash flow or free cash flow to debt. So you've still got the net debt number, you've still got the levered free cash flow, and you've still got the LTM EBITDA number. So you can do those ratios, but the classic kind of debt over capitalization, the investment bankers just won't use that very much, because it's much more about, can the structure afford the debt, and that's already a cash flow issue rather than necessarily a capitalization issue.
Great stuff. There's more. So Anthony is asked, is the LSCF modeling approach feasible to implement in a model built following the
so I know there's a lot of standards out there, and I think this is the really big difference in the industry between people in, say, investment banking and people in, say, project finance. Because in investment banking, so one of the really big issues in investment banking, you generally are not creating assumptions. You are relying on your research estimates or a confidential information memorandum or your client to give you the main assumptions. You're kind of broadly got your kind of income statement and your key balance sheet items that generate cash flows almost given to you, or you have to make kind of very simple assumptions around some key numbers. So the days of the really large models in investment banking are kind of gone, unless you're in probably a credit team, a leveraged finance team, or a project finance team. If you're in, say, consumer, industrials, people just don't want to do that. And part of the issue is, I think they are kind of shying away from situations where if you make mistakes. So every M&A deal that a large bank will advise on, and they do a fairness opinion for, where the bank kind of puts their quality stamp on it, there'll be a team of lawyers who will run through the fairness opinion, which is disclosed to the public, and they will try and find errors. And there was an example of one large bank where they made an error in the share count, and they got sued by a class action suit for about $300 million. So there's a real reticence of creating really enormous models that can kind of potentially have mistakes in mergers and acquisitions for very large public companies, because they're just really wary of making something too complex. So don't get me wrong, I'm not suggesting for a moment there shouldn't be standards. And I think in project finance and in large leverage finance models or credit models, there's a total room for that. But I think in the classic investment banking, where you are working on things like levered free cash flow and net debt numbers, people who just want it not to be too complex.
Great. I've got a question myself.
Sure. Alastair. Go ahead, Giles. You're gonna nix me now, right?
I'm going to try and make it controversial. So if I was being really cynical, some of what I think I heard was bankers like to make their own life easy. They like to keep the model simple, and perhaps a project finance modeler is more interested in getting the full comprehensive details. Does that mean project finance modelers are better modelers than investment?
Yeah, I would absolutely say that. I'd totally say project finance modelers are better modelers. And let me kind of just give you, so when you're doing a project finance model, so in project finance, if you think about it, you have a special purpose vehicle, and you're trying to basically push all the risks away from the special purpose vehicle to people who can handle them most easily. So you have a kind of construction contract that's handled by the constructor. You'll have a take and pay contract. So you kind of push the risks away from the SPV. And in most cases, the project finance asset is generating very, very predictable cash flows. Okay, whether it's a bridge and you're charging tolls, or you're pumping oil out of the ground, you're pumping gas, or you're doing a wind farm, you've got actually pretty predictable cash flows. So you can kind of nail it in terms of the model, and you can build very, very detailed models. So you've also got to be careful of the accuracy. But say in investment banking and M&A advisory, you are typically building a model of a massive company that does lots of different things, and you just don't have time often to kind of go in the granular detail to do that. And it's much more about the financing structure supporting that and the financial effects of putting two businesses together. So I just think the needs of the model are different. And I absolutely would say if you want to like a rock star modeler, Giles, I'd probably go to someone doing project finance rather than investment banking. But investment banking is really kind of deal analysis and valuation analysis as opposed to kind of really detailed modeling. Don't get me wrong, modeling is important in there, but you'll find it's more important understanding the financial effects of the transaction than necessarily building a really detailed model. I think people are just wary of if you think about an M&A deal, it's really time compressed. Whereas a project finance deal may take, I can remember at J.P. Morgan, we worked on the project finance of the Qatar gas development, and they had 3 projects. They had the projects of all the refining stuff, and then they had the projects building all the shipping terminal, and then they had the project of actually building the ships to ship it to Japan, because that's what they've originally did. So it's like a 3 project finance, and I think that took like 7 years to do. There's one MD at J.P. Morgan whose whole career was basically Qatar gas, and they had enormous models. But this came up actually because of this leasing issue, and we were talking to our clients, and they said, look, honestly, we don't really do 3-step modeling. We just do the cash flows and the income statement. And I was kind of thinking, oh my gosh, we've been teaching this for years. But they did say, don't stop teaching it because it's a really good learning experience for people.
That's great. You ruined the controversial nature by totally agreeing with me straight away. But
yeah. Well, no, I agree, and I actually think it's right. I think that's why in project finance it's very kind of modeling focused and kind of Excel focused, because that's the nature. You've got very predictable cash flows, and so you're able to do that with a lot of certainty.
Great stuff. We're almost close. The only other thing I would say is you kicked off a great debate about offset versus index, which
I know. Just a lot of people say, "Oh my gosh, auditors would kill you." I know. I just squeezed that in because I had a bit of extra time. I know it's a bit naughty, but if you're doing some scenarios and you just want to overly, so I generally use the offset function where you have a single row assumption, and then the choose function where you have like multiple assumption blocks, and then you can just copy it down. But look, it's horses for courses. You've got to be super careful with everything. So totally pinch of salt, use it with care.
Fantastic. All right. Well, thank you very much, Alastair. Thanks everyone for joining. If you've got a spare 10 minutes, I would suggest you have a look around, have a look at the lounge area, the expo room. There's a networking feature where you can connect with others one-to-one. And yeah, thanks so much. That was a great presentation. And
thanks, Giles. Thank you for having me. Really appreciate it. And I will make sure that model is sent to everybody who wants it.
Thanks, everyone.
Okay.